Chapter 2 has to do with the ways that we can understand the various costs that we incur in our firm. And Part A has to do specifically with different types of costs. Now, a cost is basically a sacrifice of resources, but the nature and the timing of that sacrifice can make a big difference to the way that we understand that cost. There are several types of costs. One type is called an expenditure. The word expenditure comes from the word expend or spend. So that means that expenditures are outlay costs. In other words, we are paying for something. We're either paying for it in the past or in the present, or maybe we haven't paid for it yet, but we will be paying for it in the future. And the reason that we're paying for something is that we expect that it's going to be useful to us. Now, that's slightly different from the concept of an expense. Expenses relate to GAAP. Generally accepted accounting principles require that we follow the matching principle, which says that we have to match our expenses to the revenues that they help us to generate. This is very important when it comes to computing income, but it means that the timing of when we recognize an expenditure, paying for something, and when we recognize an expense on the income statement may be significantly different. Sometimes we pay for things in the same period when GAAP allows us to recognize them as expenses. In that case, they'll occur at the same time. Sometimes we pay for things first and recognize them as expenses later. At other times, we may recognize the expense now and not recognize the expenditure later. Another issue is behavior of these costs. A sunk cost is one that has already occurred, or occasionally one that we have committed to. Because of that, sunk costs are sunk. That is, there is nothing that we can do now to change them. Because of that, sunk costs really should not affect our current decision making. By contrast, opportunity costs haven't occurred yet. They occur whenever we have to make a choice. If I choose option A, that means I can't choose option B. And therefore, the cost of choosing A is whatever I give up in option B. By contrast, if I choose option B, that means I can't do option A, and therefore option A becomes my opportunity cost. There's a lot of confusion in the business world about sunk costs and opportunity costs. Most managers pay way too much attention to sunk costs. It's very hard for managers to recognize that they've spent money in a way that didn't help out the firm. Because of that, managers tend to want to spend more money justifying the sunk cost that they've already made. Usually this doesn't work out well. The best thing to do with the sunk cost is to learn from it. If you weren't happy with the way things turned out, try to do differently in the future. By contrast, most managers have trouble recognizing opportunity costs. That's because it's very easy to measure how well something worked out if we chose to do that thing. But it's much harder to assess the value of the road that we chose not to take. But recognize, every time you have to make a choice, you're giving something up in the choice that you did not make. Your goal is to minimize regret, to make sure that your opportunity cost is as small as possible. Another way to think about costs is in terms of product costs or period costs. Product costs are the costs that we attach to the inventory that we sell. Because of that, GAAP requires us to capitalize those costs as inventory on the balance sheet. And we don't get to recognize those costs as an expense until the inventory is sold and that cost becomes part of cost of goods sold. This is another example of following the matching principle. We can't match the cost of inventory to revenues until the inventory is sold and generates revenues for us. By contrast, period costs are always expensed as incurred. Take, for example, rent. We used our place of business this period. We recognized the rent as an expense in this period. Next period, if we want to use the same place, we have to pay rent all over again. Now let's take a look at an example. A developer plans to buy land so that he can construct a building. He's picked out 4 possible lots, and we're given some information about each of those lots. Specifically, we're told the expected net return. That means how much revenue does he think he's going to get from each one, minus the costs that he expects to incur for each one. So now we need to look at each of these lots. The question is, which lot would he choose? Think about it for a minute. Did you choose lot D? That would make a lot of sense because the return on lot D is significantly higher than the other choices. Now the question is, what is the opportunity cost of his choice? The answer here is lot B. In other words, his second best option was to get a return of $190,000 instead of a return of $200,000. Therefore, his opportunity cost is $190,000, the value of his second best choice. On the income statement, we always have costs because it's impossible to generate revenue without them. But costs are recognized a little bit differently depending on what kind of a business we run. For service businesses, we recognize service revenue minus the cost of the services that we provided, and that gives us our gross margin or gross profit. Then we subtract out all of our marketing and administrative costs to arrive at our operating profit. For a merchandising firm, we take sales revenue minus the cost of goods sold. For a merchandising firm, that would be the sum total of all of the cost to acquire the goods, which we then sold to our customers. And that difference gives us our gross margin. We'd like to sell our goods for more than it cost us to acquire them. Then we subtract out our marketing and administrative costs, and that gives us our operating profit. An income statement for a manufacturing firm looks very similar to one for a merchandising firm. However, the computation of cost of goods sold is significantly different. For a merchandising firm, all we have to do is add up the purchase price of the merchandise that we got from our suppliers. By contrast, for a manufacturing firm, we're going to need to consider all of the materials, all of the labor, and all of the overhead that we need to put into the goods that we manufacture before we're ready to sell them to our customers. And we'll see how to do that later on. Once we have subtracted the cost of goods sold from sales revenue, we have our gross margin. Then we subtract out all of our marketing and administrative costs to get operating profit. Let's look a little bit more at the costs in a manufacturing firm. Some costs are considered to be direct costs. Others are treated as indirect costs, and you need to understand that difference. Direct costs are traceable. That means there is a paperwork trail showing how much of those costs went into the various products that we manufacture. Generally speaking, that would be direct materials. We know how much of each direct material went into this product or went into that product. Also, direct labor. We know which of our workers were working on each of the products that we made. So there's relatively little uncertainty about how much of the direct costs went into each of our products. By contrast, indirect costs can't be traced. That's why they're called indirect. So what would be included in that category? Generally, we call indirect manufacturing costs manufacturing overhead, and it includes a couple of specific categories. Number one, indirect materials. That is physical materials that we've acquired and that we use around the factory, but they are things that do not become part of the products that we make, like light bulbs, cleaning supplies, paper towels in the bathroom, or they become part of the product, but not in a way that we can trace easily, like glue. Another category is indirect labor. That includes all of our workers' time that they are at work, and they are getting paid for being at work, but they are not working on specific products. For some workers, the indirect labor portion of their day occurs while they're waiting around for the machines to be set up, while they're at lunch, or while they're attending a training seminar. For other people who work in our factory, their whole day is indirect labor because they are supervisors. They don't work on any particular job. Instead, they make sure that things are going smoothly for the people who do work on particular jobs. The third category of manufacturing overhead is other overhead items. This is all other costs associated with our manufacturing site that don't fit into any of these other categories. So that's going to include our factory rent, the cost for electricity and water. It would include depreciation on the building or on the machinery, any insurance that we carry, any certifications, all other costs of having this manufacturing site. Now, what are we going to do with these costs? We need to understand them, and whether a cost is direct or indirect really depends on what's called the cost object. The cost object is the thing for which we are trying to answer the question, how much did it cost? If our cost object is a single unit of our product, then our materials and our labor will be traceable, and our other costs will not. They'll have to be treated as manufacturing overhead. But supposing that we're trying to find out how much it costs to run a department, or how much it costs to run our Cleveland factory versus our Pittsburgh factory. In that case, a lot of costs that were indirect for a particular item would become direct if the cost object is a factory, because we know how much rent, how much utilities, how much depreciation would be consumed at each factory site. Now, we can also slice and dice our manufacturing costs in several ways. One way is to consider total manufacturing cost. Total manufacturing costs include all of the materials, all of the labor, and all of the overhead that we used to manufacture our various products during the period. So these are all going to become product costs, and whether they end up on the balance sheet or on the income statement is going to depend on whether the units to which they are attached are sold or not. If the units are sold, the costs go to the income statement as part of cost of goods sold. If the units are not sold, then the costs are capitalized, that is, turned into an asset and recorded on the balance sheet. There are, however, other ways to understand these costs. One way is prime costs, which includes direct materials and direct labor only. Therefore, we can say that our total manufacturing costs are our prime costs plus our overhead. And this is convenient sometimes because, generally speaking, materials and labor increase proportionately with the number of units that we make, whereas overhead usually doesn't. Another way to think about our costs is in terms of conversion costs. That is direct labor plus overhead. In that case, we could say that our total manufacturing costs are our direct materials plus the conversion costs that were needed to transform those materials into finished goods. And we will use all of these formulas for manufacturing costs during the course of the semester. A firm also has non-manufacturing costs, things that the firm does that they need to do but are not directly associated with manufacturing their product. One category is marketing costs, like advertising, sales commissions, and freight out. Another category is administrative costs, the costs of running the firm, including executive salaries and data processing costs and any legal costs. A third category is research and development, which is very important for the firm's ability to meet its customers' needs, but it happens before the manufacturing process begins. All of these costs are treated as period costs. That means they go directly to the income statement this period, and next period we assume we'll have more marketing costs, administrative costs, and research and development costs, and we will recognize those on the income statement for next period. Why does GAAP tell us to do this? There is some uncertainty about whether these costs have future benefits. Do they help us to generate income in this period, or do they help us to generate income in subsequent periods? It's very hard to answer that question, and because of that, GAAP says we don't know whether these costs have future benefit, even though we really hope they do. We hope that our marketing in this period will help customers to buy our goods in the future. We hope that smart administrative decisions in this period will help our firm to do better in the future. And we hope that research and development that we do in this period will help us make better products and more sales revenue in the future. But since we don't know how to separate out current benefits from future benefits, GAAP says we follow the conservatism constraint and recognize these as expenses in the current period.